Whenever you talk to other traders, there's always someone who feels that certain trading rules are gospel and other rules are foolish. Sure, trading rules about cutting losing trades off the knees when it's hit that point that invalidates the premise is one that I personally can get behind. Those rules are all about saving your trading account because once the account is finished, well, so are you. But there are other rules that many trading courses talk about. Rules that many traders hold dear and they follow to the letter. The issue becomes when you can't see the folly behind buying into your rule and discounting other trading rules. There's more than one way to make profits. There's more than one way to enter a trade. There's more than one way to deal with risk. The issue is finding what suits you as a trader and fits the trading style and the plan that you've chosen. I want to recreate a chat with two traders that I had, where each had separate thoughts on two very popular variables in trading that we have all heard and read about. Scaling out of your position as a trade goes in your favor allows you the benefit of taking profits and reducing your risk at the same time. Now this chart here, it shows a trade entry that may or may not be valid. This is just for a sample purpose. The trade rallies nice, and the green line represents a higher time frame swing level. These areas do have a tendency to hold up price, and if this move is a trend continuation, it should break the level. We don't know if it will break the level, but we do know that these levels do have volatility as different interests take action. A safe scale out that reduces risk is right before this area where you see first scale. You can see that there were competing interests at this level as shown by the yellow box, but the buying pressure wins the battle. So price makes it high, but there is no structure to the left that stood out and would indicate that there could be resistance in that area. Price falls, but then it rallies again, but this time there is clearly a structure level where we could take profits. As price rallies, it hits the high where you would scale out again, the second scale. Now clearly this level had selling pressure. And it could be others who use this level to exit longs, maybe, which, depending on your strategy, could have you buying the lows when price starts to rally again. Now, the main issue people have with scaling out is that if you don't hit the first scale out and price reverses, you get stopped out full position. On the flip side, your profits are not full position profits because you've taken off positions while the trade was moving in your favor. That's a fair point. Now, the other trader in the conversation was not a fan of scaling out for the reasons of less profits and full stop outs. This trader stuck to his guns, and he actually called scalping out your trades foolish behavior. So he went on about his trade system, which was, in brief, using limit orders for entries and target structure levels for profits. It's pretty common basics that many trade plans call for, but there's an issue this trader didn't really think about while he was bashing the scaling out. I told this trader that his limit entries have issues that can have a huge consequence on his profitability. Now first, what's a limit order? Well, a buy limit, for example, it's an entry order that sits below current price. So if or when price reaches or trades through your entry price, you're filled. Now this allows you the benefit of having the market come to your price and not have you chasing the move. But there's a problem. Take a look at this chart here. The line A represents resistance busted through, and the trader sets a limit order in that area to catch the bounce. The stop is placed at B. Now, as you can see, the trade gets filled and then stops out for a full loss. Now here at C, we have a trend line from the highs off to the left. A limit order is set at the line, and what you can't see here, but there's a small congestion area to the left that helps support this trade. Price punches down to the area, misses the limit price, and then rallies strong for over 400 pips before offering another possible entry area. So do you see the problem here? While this trader bashes scaling out, he fails to understand that he will participate 100% in all losses as well. However, he will not participate at all at times on large moves if price does not come to his area. Now, as a side note, if your trade plan uses limit orders for entries, have you factored in no fills into your testing to see if you have valid samples? Now, keeping an open mind is paramount when choosing a trading plan, trading rules, and a trading method. Now, this one trader was so adamant that scaling out was a fool's game that he totally missed the boat on the downfalls of his own trading method. Now, there's nothing perfect about trading. There's going to be trade-offs in many aspects that you should account for when deciding on your plan of attack. All of the trading rules and trading truths, for the most part, can be rethought and dissected as they pertain to you as a trader. So question everything that you hear, question everything that you see, and question everything that you read.